I don't know someone who does have it.
Yeah. Okay. Good morning, everyone. Good morning. Well, first of all, we're very glad that the weather has been reverted here in Hay, and you understand why, on a day like this, no sane person would be anywhere else on the planet. Okay? Just to say a few words about this weekend. We've enjoyed it tremendously. We'd like to think that it could become a regular event. If anyone has any thoughts on this and participating in future weekends, let us know. You have our email, we have your email, and we would also love your feedback. This was the first time we've done this. We got some things right, we got a lot of things wrong. Do let us know. We've been talking about mistakes, we've been talking about investment. We've tried to draw those threads together for this penultimate session, which is really learning from mistakes, applying them to the investment world. Now, economists have a term, learning by doing. And it's basically you get better at doing stuff by repeating it. But that's actually a fancy word for the world progressing by mistakes on a technological and economic basis. We're going to focus on that in the investment process, and we're going to let Edward make a few comments, and Russell would like to pick up any loose ends from that.
Thanks, Paul. So the game of investment is really one of learning by one's mistakes, or trial and error. As Jim Grant says, we keep on stepping on the same rakes. We keep on making the same mistakes, so we can learn from past errors, from the errors of others. As Jim also says, progress in the physical sciences is linear, but in finance is cyclical. Things go round and round. But what we find, or at least what I find, is that the best investors dwell on their mistakes. Apparently Zygmunt Warburg would advise his investment managers always to cry over spilt milk. And George Soros wrote an interesting comment about mistakes in his Alchemy of Finance. He writes, "To others being wrong is a source of shame. To me, recognizing my mistakes is a source of pride. Once we realize that imperfect understanding is the human condition, there is no shame in being wrong, only in failing to correct our mistakes." Now, it so happened by coincidence this last week, I was rereading Jesse Livermore's, the book about Jesse Livermore, Reminiscences of a Stock Operator, one of the most famous investment books. And actually, much of the text is really about Livermore examining his mistakes, confessing to his mistakes, and rueing his mistakes. He writes at one stage, "Of course, if a man is lucky and wise, he will not make the same mistake twice, but he will make any one of the 10,000 brothers or cousins of the original. The mistake family is so large that there is always one of them around when you want to see what you can do in the play of the fool line." Another point, after mentioning a mistake he made, he writes that the loss of money didn't bother me. When I have lost money in the stock market, I've always considered that I've learned something, that if I have lost money, I have gained experience, so that the money really went for a tuition fee. A man has to have experience, and he has to pay for it. Now, one of the nice things about working for an investment firm is that the cost of that experience is paid for by your clients, not yourself. And Livermore says elsewhere that the mistakes pave the way for greater success. But then one should bear in mind that Livermore's own life ended in suicide in the coat room of the Sherry Netherland Hotel in New York in 1940, where he blew his brains out, having lost his fortune for the third time. And he wrote a note to his third wife saying, "My life has been a failure, my life has been a failure, my life has been a failure." So even Livermore, who dwelled obsessively on his mistakes, didn't seem to get it right in the end. Now, as I was preparing some thoughts on the type of mistakes that are made, I think there are certain categories of mistakes, often really the opposite ends of the extreme. Keynes's colleague A.C. Pigou referred to errors of optimism and errors of pessimism. Those of us who specialize in analyzing financial bubbles deal in large part with the errors of optimism. But there's equally more dangerous, or just as dangerous, the errors of pessimism. In the bear market, when things are very cheap, people become paralyzed and fail to invest. There is this question of whether you are investing for the long term or speculating. I think some investors think that they're investing, but in fact are speculating. Yesterday, when on the panel on the session on booms and busts, there were one or two questions about how can one get the last stage of the boom. They say, for instance, we've got this AI bubble at the moment. Are you going to run with the bubble? Do we know when it ends? But once you're in a bubble, you're in effect, if you choose to stay in it, you're in effect speculating. You're in effect saying how close you know you are to the end of the bubble. And famously, Stanley Druckenmiller, George Soros' sidekick, was long tech stocks, dot-com stocks, in spring of 2000, just as the dot-com bubble burst. And Druckenmiller didn't believe for a second that the dot-com stocks were valuable. He was just running with them. And in defense, he said, "I thought we were in the third innings of the baseball game. It turned out to be the ninth." I think investors sometimes, there are these errors of putting all your eggs in one basket, the lack of diversification, but you can also have too much diversification and not really have the conviction of your bet. You can be too early, and it's very painful to be too early. My old boss, Jeremy Grantham, at GMO, took an early bet against US equities in the 1990s and lost half his clients walked out the door. Now, every bet he was making at the time paid off very well, but if Jeremy hadn't been the founding partner of his firm and the leading shareholder, there was no way he would have kept his job. There were other investors, such as Tony Dye at Phillips & Drew and Gary Brinson at UBS Brinson, who were shown the door just towards the end of the bubble. So it's important not to be too early, but if you're too late, you're also going to lose money. This question of taking losses, you heard earlier about that out of loss aversion, people are reluctant to take losses. It's not clear to me that that's actually a useful strategy. If you're a value investor, you should be doubling down, as if you have a conviction in your position, as the stock becomes cheaper. In fact, most of the returns from small cap and value come from rebalancing the portfolio, which means selling your winners and buying your losers, which is in direct contradiction to the normal advice that one hears, and actually it's reiterated time and time again in Jesse Livermore's book, that you should, as Ricardo says, sell your losses and let your profits run. As for behavioral stuff, I'm a bit skeptical about most behavioral finance advice. We employed one of the best-known behavioral finance guys in the UK in our investment firm, and I have to say, he never came up with a good investment idea, and didn't really seem to be able to bring these so-called insights of behavioral finance into the practical world of investment. Russell knows who I'm talking about.
Everybody knows who.
Anyhow, he also didn't turn up in the office very often. He was the first person to start working from home, which irritated me tremendously. But the one sort of finance, sort of psychological error that I do think a lot about, and actually I give a course on Russell's, a lecture on Russell's course, about the so-called capital cycle. But what I find, and I think investors do it the whole time, is they linearly extrapolate when we live in a cyclical world. So when things are going well, they extrapolate things going well into the future, even if conditions are about to change. And when things are going badly, they extrapolate that to the end. And that I think is a great source of error. I think that the traditional dichotomy between value and growth is an error. A lot of investors, those who are slightly older, would have been brought up to think that value always outperformed. Anyone over the last 20 years would tell them that's not the case. The value investors also were told, they also prided themselves on never paying attention to macroeconomic conditions. And on the whole, that's fine. Economists can't predict anything. The best economic prediction, as they say, is the rearview mirror. It's the assumption that what happened last year will continue in the next year. However, there are times when paying attention to macroeconomic conditions are very important. One of the best, or at least what used to be one of the best, value investment firms in the United States, Branders, had a very good record. You'd go into their offices and they would have, under glass case, the first edition of Graham and Dodd's security analysis. They employed a devil's advocate at their meetings. They did all the right things. However, they went into the global financial crisis saying we don't pay attention to macro, and piled into the banks, and the home builders lost 75% on those bets that were large bets, and permanently destroyed their past investment record and ruined their reputation with their clients. So in the end, I think that the more I think about it, there are no real investment truths. Everything is constantly changing. And in order to come out with a decent result, one needs to both analyze one's own errors, but also analyze how the world is changing and how the precepts of the past may no longer apply to the present. All right? You agree with that?
Yeah, I agree with all of that.
Before I pass it over to Russell, many times this weekend, Edward has referred to his former colleagues at GMO. Now, they put a lot of stuff out online, which is really excellent reading, and it's free. There are very few free gifts in this world, free rides, but do check it out. It is really worth it, and especially on a cost-adjusted basis. Russell.
Yeah, and I agree with that on the GMO stuff. It's exceptionally good. And long-term, this is the important thing, it's not short-term noise, it's long-term analysis. What I'd add on Edward is, obviously, as the keeper of the library of mistakes, I get sent a lot of quotations of mistakes. The one we chose to put up in the library in Edinburgh in gold lettering is from James Joyce. And Joyce said that mistakes are the portals of discovery. Maybe a discovery about yourself, but they are important. The library of mistakes is not just a library of mistakes, and we need to get over that. It's a library of business and financial history, and over today and yesterday, that's what we've been discussing. And it's there to get people to learn from history, whether mistakes or successes. But it may be easier to learn from mistakes. So there are, I should have worked this out, there's at least 300 books on Warren Buffett, but there's only one Warren Buffett. You can read and read and read and read about Warren Buffett, but somehow we can't be Warren Buffett.
Has Warren Buffett read any of them, do you think?
I think his success suggests he hasn't. So is it easier to learn from geniuses or idiots? And I think it's easier to learn from idiots. Now, years and years ago, I went to see a professional tennis player called Peter Burwash, who was on the speaking circuit. And I don't play tennis, but Peter Burwash explained that there was a very simple tactic for winning at tennis, amateur tennis, I should stress, only amateur tennis. And this tactic was really almost foolproof. The secret to winning an amateur tennis was to hit the ball over the net. And then the other person would not be able to hit the ball over the net, and one would win at amateur tennis. And this is why I think mistakes are important, because we can't all be Warren Buffett, but perhaps we can make fewer mistakes. And that's the beauty of investment. I mean, there are many bad things about it and good things about it, but you don't need the right answer. This is the beauty of it. You just need a better answer. That's it. I mean, remember, these financial instruments that we all buy are discounting mechanisms. They're discounting the future, and they're discounting a range of futures. And if one can have a better answer, even if it's not exactly the right answer, one is likely to prosper. And therefore, simply not making some of the mistakes. So that is maybe why we're here to discuss mistakes. The other thing I like to say about the library is it's our black box. So the one profession that does learn from its mistakes are pilots. It's very clear from the literature that pilots really learn from their mistakes. I should rephrase that. It's not always the pilots who make the mistakes who get to learn from them. But that's sadly, I mean, that's a tragedy, but sadly, the black box is there for a reason and we learn from it. Now, the Business and Financial History Library is a black box of success and failure, but it's a black box and recorded. There's a saying, I'm not Scottish, you can probably tell that from my accent, but I've lived there for a long time. They have a saying in Scotland that when something goes wrong, what you say is a big boy did it and ran away. It's very easy to blame mistakes on somebody else. We need a black box. So in Edinburgh we have the black box. In Lausanne we have a black box. In Pune we have a black box. One day, hopefully, we'll have this black box in London. And that's why we need to do it. And I think it can be very, very profitable. In terms of, I think we'll probably get on to mistakes, but I was really interested in what Edward said about the errors of pessimism. Obviously, I've written the book on that, so that's the anatomy of the bear. But one thing I think you can all do is when next time you read the financial press, start on page 4. Don't start on page 1, because what's on page 1 is the concept. I mean, page 1, 2, 3, and 4 is what the editor at that point in time is picking up for the information that is bombarding them. And remember, the editor, I'm looking at an editor here.
I'm waiting to see what you're going to say next.
Yeah, and it's just natural. That's what all of us do. We order it in what we think is the importance, and that's based on what's buzzing around in the ether. And when I wrote that book, I read 4 months of Wall Street journals from 1921, 1932, 1949, 1982. And I found lots of wonderful stuff in there that told me things were getting better. The newspapers were reporting it. It was just from page 5 onwards. So to get this mistake of perception, we're saying, how can you have an advantage on somebody else by mistakes? Well, it's maybe just ignoring, maybe not ignoring, but starting on from page 4 onwards, trying to get a better view of what's actually happening. The first 4 pages, or actually they are facts, but they're more opinion because of where they're ordered. And I've got lots more to say on the statement.
Couldn't one go further and say, don't bother to read the Financial Times?
No, I definitely wouldn't say that.
My position.
In writing the book, I came to the opposite conclusion, is that you really have to read the financial press because you have to get an idea of what the consensus is, and you have to get an idea of where the mistakes might be relative to your own reality. And well, I should hand it over to the editor now.
Well, I was going to say that once everything started to go online, I still asked all the people who worked on our business at Money Week, and still do now, would suggest to young people, in fact to everybody, that they read 2 newspapers a day from beginning to end. It doesn't take very long, there's not much in newspapers anymore. But as Russell says, if you just look at the front, or if you just look at the first couple of pages or whatever you're reading online, you'll miss all the bits and bobs that will help you make the connections. And if you read any of the really good opinion journalists, or indeed any of the best financial analysis, you'll always find that it starts with some little anecdote from somewhere in the back of the paper, or somewhere from a magazine that you haven't read, something from the back of the New Scientist, whatever it is. All the connections are made off the front pages. So it's really important that you read in print. I'm still a great believer in print. You read in print 2 newspapers a day. And I want to pick up on something else that Russell said, because this is incredibly unusual for Russell, but he completely misunderstands something. I don't think I've ever said that before, so I'm just going to say it again. Russell has completely misunderstood this thing, which is the nature of financial publishing and how it works. So there are 100 books on Warren Buffett and how Warren Buffett invests, not because anybody who writes any of those books thinks for a second that anyone will follow any of the advice in them, but because we know that people will always buy books that might make them think that they're going to make an effort to be better. So the financial publishing business, and in particular the investment advice business, is exactly the same as the diet book business. And that's what we always say, if diet books worked, you wouldn't need diet books, right? And if financial advice books worked, you wouldn't need financial advice books, so you just need one. So this has nothing to do with the fact that you can't imitate Warren Buffett by using these books. It's that nobody tries. In the same way that nobody tries to eat 800 calories a day for 5 years until they weigh 60 kilos. It just doesn't happen because it's too hard. So you're right in that I agree with you in that it's the particular personality, but it's not so much that the books don't work, but that nobody uses the books.
So on that basis, do you think it would be easier to learn from books on mistakes than books on genius? Or it wouldn't really make any difference?
It doesn't make any difference.
Nobody would open them anyway.
I mean, people have on their shelves. And the classic of this actually is entrepreneurial books, starting a company books. If you really want to make some money but know that no one's going to follow your advice, right? So you can write any old nonsense between the pages. Literally doesn't matter. Write a book about how to start a company. Get it on the shelves at W.H. Smith. Millions of people buy it. No one will open it. No one's going to start a company.
But that basic wisdom, though, of reading the news, a couple of newspapers, and joining the dots, that is akin to Roger Federer. The harder I practice, the luckier I get. Okay.
But it's also where you make the little connections that make stuff work.
Yeah. Okay. Now, Merryn, you have successfully punctured the bubble of idealism. So let's get to the current environment. Where do you see the mistakes that we can all profit from?
Mistakes right now.
Yeah, I'm bringing up the sordid subject of money.
Sordid subject of real money. Okay. Well, we talked about this a bit this morning at the investment breakfast, where very kindly 3 random audience members joined me to talk about investment. Thank you, Emil. Still here. Very kind. And we talked about a variety of things. One of the things that did come up was, where do you put your money now? What do you buy? And we talked at length about the UK stock market, which is possibly the most unloved in the world. Well, maybe give or take, but the most unloved investable market in the world. Phenomenally cheap, particularly at the small cap level, relative to pretty much any other market, even when you take into account the composition of the market. This is a very cheap market on any valuation measure you care to mention, but it's still pretty much ignored by not just UK investors, not just our retail investors, our big pension funds, and also by global investors who look at it and go, oh, well, I don't know, Brexit, I don't think I can buy that. So the mistake that so many people are making globally is to be blinded by something that happened years ago and allow something to discount it too much. So you have this very cheap market. We talked earlier about how wonderful it is that it provides a great dividend yield as well, which you can hold while you wait. And then on top top of that, possibly I've probably said this too much recently, but there is in the UK a once-in-a-generational opportunity to not just buy, this is not investment advice, by the way, simply information.
Just say.
To buy very cheap stocks. And then on top of that, you have the investment trust market, which Russell is also a part of. And investment trusts are a very UK-specific thing. Companies, the business of which is to buy companies, yes?
No, I was going to say we do have some foreign students in the audience, so thanks for explaining.
A company, the business of which is to buy other companies or infrastructure products or assets of whatever kind. So the investment trust business, as I say, very UK, you can get a discount on a discount. So the share price can be trading at a discount to the net asset value of the underlying assets, which are also trading at a discount to their underlying value. So you get a double discount occasionally. And very occasionally, you get a really whopping double discount. And right now, discounts on investment trusts are about as high or low, depending on which way you look at it, as they ever go. And historically, every time you've seen discounts widen out of this kind of level, you tend to see really very good performance over the following years. Now, we're at the point, we're at the deep pessimism point of this, where everyone looks at this and they say, well, it's they're cheap for a reason, this is awful, everything about the UK is awful, the investment trust business is a disaster, and there are lots of reasons. Am I boring everyone about investment trusts? No, okay. There are lots of reasons why investment trusts do trade at a discount at the moment. There is, lots of them are very small, or small in terms of what wealth managers will and won't buy. So back in the old days, the wealth management companies were big buyers of investment trusts, but now that the investment trusts have consolidated, and so their portfolios are more model and much bigger, they can't realistically buy anything under, well, we used to say 300 million, now we say 400 million, and now we're closer to $1 billion, which means that lots of the investment trust market is outside their remit. There's also a cost problem. The way that the regulation works at the moment, you have to put all the costs of the investment into the cost that you show the client. So in a open-ended fund, for example, you would only tell people, well, the management fee of this is 1% to 100 basis points, and you wouldn't tell them the cost of everything inside, because that would make it seem a little ridiculous. With an investment trust, you have to tell them the whole lot. So very often the cost can seem very high, and then people don't want to buy it because it's too expensive. It doesn't fit in with their profile. So there's lots of justifications for it, but none of that takes away from the fact that this is an extremely cheap sector, an extremely cheap market. So we have a huge volume of money still flowing into the US market, into the Magnificent Seven that we talked about earlier, which if there was ever an obvious bubble, this is an obvious bubble, although maybe Russell disagrees. Do you disagree, Russell?
No, I agree with that.
And completely ignoring something that is really very inexpensive, and for which there may soon be a catalyst, because everybody says, well, why would I buy that? It's been cheap for ages, it's always going to be cheap. Everybody knows how miserable the UK is, which it isn't. And so why would I buy that? And the answer, of course, is that yes, that if you're a retail investor, it doesn't matter. We talked about reversion to the mean. You can wait. And if you're not a retail investor, you can look around and say, well, what might make this change? What might happen? And there's so much chatter, so much conversation at the regulatory level and at the government level about how to turn around the UK stock market, that for once, just this once, there might actually be an opportunity to see something cheap and to see the catalyst. Does that count as a mistake?
I made the observation at a conference in Ireland about 6 months ago that the UK was an attractive and cheap market to invest in, and my career as a stand-up comedian took off on the basis of the reaction from that audience.
There you go. You see, that's the mistake, laughing at the UK stock market.
Can I add sort of corollary to Merryn on UK's small cap value? Is around the world there now is all the markets, not just the US, are showing huge bias towards the mega caps, the large caps. I mean, Russell, you tell me how the Magnificent Seven are what, 40% of the S&P, something like that?
Well, it's as concentrated
29.
as we've been since the Nifty 50. There's been nothing like it,
Yes.
even in the dot-com bubble.
And yet the US is not the most concentrated market. It's probably, I saw a list last week published of probably about 20 stock markets. US concentration in US stock markets probably actually in the bottom half. And there is, perhaps from a personal investment perspective, the greatest mistake I've made over the last 10 years, not just to be invested in the index, because it's been remarkably difficult for investors, active investors, to beat the index. But one of the, and indexation has grown very, very rapidly in the post-crisis era. Tens of trillions of dollars, roughly more than half the US stock market is now, is that right? On the hands of indexes.
It is,
Now,
it's just gone over 50%.
Yeah.
yeah, so and I like to get, I thought you and I didn't do figures.
I actually have a remarkable number of figures in my head.
Okay, yeah.
About three.
The process of indexation, of going to indexation, requires investors to sell small cap stocks or sell whatever they're holding and then buy pro rata the index. So you put a large company, Microsoft, gets a larger chunk of your investment. So that process of moving towards indexation actually squeezes the smaller cap stocks and benefits the larger cap stocks. And so we get to a situation today where the Magnificent Seven have the attributes, as Russell says, of the Nifty 50, which was the first quality, one and only up until today, the only quality bubble in quality stocks that came to an end in 1973. And the idea with these Nifty 50 stocks like Eastman Kodak and Polaroid, familiar household names today, was that these were one decision stocks, that once you bought them, you never had to think about them again. Now, the Magnificent Seven have those same attributes. They are all quality stocks with quasi-monopoly positions. They've had a very good run, just as the Nifty 50 stocks, up to the peak of the bubble, had a good run of 10 years or so, in which none of those companies have gone bust. So it looked as if these companies would last forever. In fact, actually, bad things happened to quite a few of them. But we don't have just the attribute of the Nifty 50. We also have the attributes of the end of the dot-com bubble, which is you have a story of a transformational technology, AI, and which is going to improve productivity. Yeah, I mean, productivity since the advent of the internet has been absolutely miserable. And as Robert Soros said about the computer age, I see computers everywhere except in the productivity figures. In other words, this idea that somehow or other we're all going to become massively more efficient with AI, if the past is any guide, is chimera. So you've got this sort of multiple bubble, and all around the world, not just in the UK, I think in Japan, even Japan that's been on a very good run. Small cap, most of the gains in the Japan stock market have attributed
to the very big stocks.
To large stocks.
Yeah, no,
and half the market is still selling below book. Emerging market value, I mean, leave aside China.
Edward, can I ask you how this fits in with your description of the everything bubble? Because you're telling me there's lots of cheap stuff around.
Yeah, so well, I said, the everything bubble burst in 2022. In fact, actually, a lot of the meme stocks and SPACs were already massively down in 21.
I think you frightened everybody when you said the everything bubble. But now you're saying there's lots of cheap stuff to buy, because I agree with that.
Yeah, but there is lots of cheap stuff. It's not a bubble environment anymore, but I think what Edward is saying is that it's just going to stay that way. You're extrapolating, Edward.
No, what's going to stay that way? No, when you wanted a catalyst for your beloved UK value stocks, and in fact, actually what we find is when markets turn, when you get, go back to 2000, value was at a very, at almost a record discount to what we call growth. Just as it was, the only parallel then was in the spring of '73, just at the peak of the Nasdaq, of the Nifty 50. So we're sort of back in that situation. And so I think you can, and what happens when markets crashes, value, as you know, provides a buffer. So,
Yeah. But you're supporting me, but you're also doing that thing that you just told us not to do about 10 minutes ago of dividing value and growth into different things, when effectively all investing is value investing, right? There is no such thing as anyone who buys anything without believing that they're getting value. So when you go out and you buy Nvidia today on, by the way, not a particularly high PE, right? You think to yourself, well, look at the growth there, and because of that growth and the PEG ratio, I am getting value. So I don't actually think there is any such thing as a growth investor. There are only value investors with different ideas of where the value comes from, right?
People who buy
and that's
growth
what you just told us.
can always rationalise it as cheap. People who buy bubble stocks can always rationalise the valuation.
I just wanted to move on to the catalyst for the United Kingdom. So I want to see how this lands with the audience. A Labour government. Okay, all right. So I just thought everybody would start laughing, but it is a Labour government, but not for the reason that you think. We live in this world where more people will vote this year than any year in the history of the world. And the only country where you know political volatility is going to come down is the United Kingdom. Now, that may not be because we are better than anybody else. It may be simply because we have the first past the post system. And the first past the post system is now highly likely to deliver a majority government, which happens to be a Labour government. And everywhere else in the world, these polls, well, not everywhere else in the world. I think Mr. Modi's going to do quite well in India. But anyway, most places, this is going to lead to more uncertainty, more volatility. So your point about your presentation in Ireland is we are associated with high political volatility because we have had high political volatility. And I'm a bit of an expert on this. Everywhere I go, there's a constitutional crisis. So I'm from Northern Ireland. I went to Hong Kong for the handover, and I live in Scotland. So believe me, when the Constitution is at stake, you get political volatility, and frankly, you get charlatans for politicians. And I direct that more at my homeland of Northern Ireland than I do even at Westminster or at Holyrood.
My comments were actually made in the Home Rule Club, by the way, in Ireland.
And it's going to disappear.
Yeah.
So the discount is going to disappear. The political discount will disappear, and I think that's why our assets got very cheap. Now, in terms of unsustainable mistakes currently being made, I obviously think it's the euro. So it may be that these elections we have in Europe suddenly contrast us with, well, we all know who's going to win these, not win, but who's going to do exceptionally well in these European parliamentary elections, and we're going to look like a safe haven. Okay, nobody laughed. People used to laugh. People used to laugh when I said that. So, if you're looking forward, think whose constitutional crisis is still to come. I mean, there could be a massive constitutional crisis in America, depending on who gets in. And the rise of the far right and the far left in Europe, the constitutional crises of many countries are ahead of them. Ours is behind them, whether it's the constitutional crisis of Northern Ireland, of Scotland, or a post-Brexit settlement. These are largely things that we have just lived through. And I would say that in this entire process, the most stunning thing is that we didn't fire one canister of tear gas. Let us see if that's how it works out in France. Because we know that that is not where, we should have a little chart of tear gas consumption per head of population. And the United
Can one of the King's interns get onto that, please?
There's your catalyst.
For all the faults of the United. So I had dinner with Lord Lamont at the height of the. Lord Lamont opened the Library of Mistakes, which shows he's game for a laugh. He knew exactly what he was doing. I had dinner with him at the height of Brexit. He's obviously pro-Brexit. And as we were leaving, I was getting a taxi and he was getting the tube. And I said, do you think it's really safe for you to be getting the tube, given the furore in amongst the people and the constitutional crisis? He said, the worst thing that ever happened to me in the tube is a man sat beside me and said, bollocks to Brexit. And I said, that's it. So it's a very British revolution. And we thought it was chaotic, but compared to other constitutional changes going on around the world, I think it's been fairly mild, acceptable, and it's over. So that's my catalyst for why we reevaluate the UK.
Okay. Before we go to Q&A, the subject came up of, and we're talking about politically stable places, the subject of Japan came up. Now, when When I started, Japan was somewhere that you didn't look at earnings, or if you looked at earnings, you didn't get it. And certainly Japanese companies didn't pay dividends. And about 6 or 7 years ago, you had the chance to invest in Japanese high-yield funds, Japanese income funds. So we've sort of come full circle, haven't we?
We have, and we waited such a long time. And when I write about the UK now, I think about all the times that I've written about Japan over the years with exactly the same thing in mind. You know, their stuff is cheap, they're sorting themselves out, the debt problem is being solved, you can get dividends, there's income while you wait, why don't you do this? And time again, endless pushback, cheap for a reason, we'll stay cheap, etc. And then suddenly, you know, here we are with, well, it's not, I'm saying new highs in the Nikkei. It's not a new high in real terms, it's only in nominal terms, but that's okay, because you only believe in nominal, right? So it's fine. So it's a new high to a degree. The Nikkei's finally hit the level it was at when I first started work. I think we said this the other day. But it is a testimony to the fact that if you find value and you sit and you wait, eventually, catalyst or no catalyst, it will come to you. Russell, any thoughts on that?
Well, I certainly agree on Japanese equities, and they've definitely mispriced, and certainly below the big cap stocks. The only thing I'd noted down for current mistakes is, and so this is a mistake that happens all the time, but sometimes becomes intense. So it's not intense. We spend a lot of time, first 4 pages of the Financial Times, on the cyclical. You know, where are interest rates going? Where's inflation going? This is what we care about. This cyclical. Most times the cyclical is the important, and that's not the world we're living in. We're living in a world of massive structural change, and that structural change is really our relationship with China. And there will be many reasons why Japanese equities do well, but I think it's particularly because of this change in the relationship with China. It's not true for all Japanese stocks, because some of them have big factories in China. And when you look around the world to see, you know, we are in a very cynical business here, you know. We're not talking about a good place between us and China, but if you look at the beneficiaries of that, I think a lot of them remain in Japan. So there's other reasons, not just the cheapness. I think you said it yesterday, or maybe it was Edward. The great problem that Japan has had for 30 odd years are well documented. And there are lots of causes for them, but the one we don't really focus on enough is China. Okay. And as that passes, and I think it does pass, we go into a Cold War with China, it reinvigorates many. I always had a joke with my clients, was that the day you knew the world was changing was the day that the best performing stock in the world was Mitsubishi Heavy Industries. Last year it went up, I think it was up 66% last year, and yet we're still talking about AI. You know, sometimes the market tells you something. And the reinvigoration of these Japanese industrial stocks and share prices is telling you something about the world, but it's the glittering object. As a fisherman, it's the glittering object you put in front of the fish that kind of distracts it, and that's AI. We're missing the bigger story.
But it's also, the other thing to say about Japan is that, you know, there is this flow of money, particularly from the US, that would have gone into you know, its international section is partly China, but now a lot of that flow is shifting over to Japan, so that makes a difference. Then it's also worth remembering, while we're talking about Chen, we add in the warning that you know, it is the case that whenever things go wrong in the US market, they go wrong in the Japanese market immediately after it. It always happens. So, you know, if the Magnificent Seven have a little trip up, then Japan will have a little trip up as well. Okay, so that wasn't investment advice. It was not an investment observation. Shall we open this therapy session open to the audience? So.
I'm just wondering, I've heard rumors that there's going to be... we've heard rumors that they might be raising the ISA subscription limit specifically for UK content. Would that provide a catalyst for the UK markets?
Merryn, that's for you.
I think that's a very obvious catalyst, and I have some disappointing news for you, which is that I'm not sure that the limit will be going up. What may be happening is that the amount you can put in your wrapper at the moment, next year's subscription might have to be dedicated in part or in total to UK equities. So I'm not sure that we'll see a rise in the total value. I'm not sure that's politically viable at the moment, but I could easily be wrong. But yes, it could be the catalyst. We talked about this a little at the breakfast this morning, which is that it is an extraordinary thing that you can get a tax benefit from the UK taxpayer to invest in foreign stocks, that the UK taxpayer is to even a very tiny degree subsidising the cost of capital for American tech companies. I mean, this is nuts, right? Ridiculous. So it makes perfectly good sense to say if you're going to get a bung from the UK taxpayer, then you should do something that in some way supports the UK with that money. And no one's telling you that you have to invest in the UK. You want to invest out with the UK, knock yourself out, just don't do it with the bung, right? So it makes logical sense, and it would also be a good and interesting signal to the market as a whole that the UK regulator and the UK state is on top of the idea of trying to transform the UK stock market, or certainly bring it back into play. And there is a view that it doesn't really matter. We don't need a stock market. Who cares what companies are listed? But actually it does really matter. It's a very important part of our financial ecosystem, and it is also demonstrably the case that companies that are listed in the UK hire more in the UK, operate more in the UK, and are more productive. So it's a really important signal, I think, and I really hope it happens. A lot of my colleagues do not, and it's a very anti-libertarian stand to take to say that capital should be funneled in this way. But I hope it does happen, and I think it will send that signal.
Okay. The gentleman in front of you, and then the gentleman in the row in front. Let's take questions in groups, and then there's one down here. So 1, 2, 3.
Having been in the rare position probably here of having had tear gas fired on me in France, and subsequently having marched in the very peaceful protests in London for Gaza, and seeing the narrative around that. I'm now part of mob rule, apparently. Do you think things are going to get worse before they get better the closer we get to this election? Will the UK stock market get cheaper as instability? You say it's behind us, but do you think there are a few more twists and turns to come before we get this long-awaited for election?
So election timing and...
I guess in the spirit of the last talk we had in terms of devil's advocacy and applying that to the Mag 7, because there's a lot of people out there saying, or at least a lot of academics and whatnot, saying we're in a bubble, they're going to roll over. I just sort of wonder what the arguments or credible arguments you think there are potentially out there for it. One of which I did bring up yesterday, a book that was written called The Myth of Capitalism, which essentially talks about how we are in an unprecedented, obviously don't like using that word, but era of monopolies, and it is just favouring these companies in a way that they have never been favoured before, and what potentially would be the catalyst to turn that around, because I can't see it in the US at least.
Okay. And down here on the front row. So devil's advocate, Magnificent Seven.
There's a nice website by Barclays that lists the CAPE ratio for a number of countries, and there's 4 of them at 10 right now, suggesting that others are making the mistake of being overly pessimistic. Might we profit by investing in these 4 countries, Russia, China, Turkey, and Poland? I'm looking for explicit investment advice that I can hold you liable.
Okay. Right. What could happen before the election? What election?
Eddie wants to do that one.
I'm not going to do that. I mean, because for me, I don't really like catalysts as an argument. Anyhow, it's stockbroker talk. My view is if you lay out a good investment case and you have good value, then just wait and see what comes. You can talk about catalysts till the cows come home.
Stockbroker talk. All right. Okay. I haven't really got anything to add on that one either. I mean, to be honest, I could wibble away about the coming election forever, but it would be no more value than what we talked about in the pub last night.
The period of maximum volatility is over for what's happening in the Middle East as well. So there will be, soon now there will be an end to the conflict, not the problem, obviously, but and therefore the protests of the United Kingdom will focus on peace, and not the consequences of war. So I think we've probably reached the period of peak volatility on that as well.
Yeah.
I'm not usually accused of being an optimist, but...
Did I feel quite optimistic at the moment as well? And can that take us on to the Magnificent Seven, which is very easy to feel optimistic about? And again, I would recommend a podcast I had last week or the week before with Jim Reed. We talked about it briefly this morning. And so many people are very torn on this because, as you say, you look at these companies and it does look like they transcend everything, right? They're amazing, extraordinary companies doing extraordinary things, very, very high quality. Not even that expensive, actually, relative to bubbles of the past. It's not that bad. However, they are still priced and moving as though nothing will ever go wrong. And something always goes wrong. And when we were talking about it this morning, we were saying that, you know, you can look at the PE ratios, you can look at them forward, you can look at them backwards, you can look at them 4 years out, whatever it is, and you can make a valuation case at this level, you really can. But then if you look at the chart, that's just a bubble. It's just a bubble. It always is. Nothing moves like that at that speed for that long without a massive correction afterwards. It just doesn't. And we talk about how learning in financial markets is cyclical. And here we are again. Here we are again, having to learn the same lesson again. And we're all tempted, I'm tempted too, to say, isn't this amazing? Aren't these companies just stunning? Nothing can change. They're going to go up forever to infinity, but they won't.
There's a thought forming on your left.
Yeah, so on your devil's advocacy for the Magnificent Seven, it seems to me that the assumption is that we had this AI revolution, and that the gains of the AI revolution will be had by those Magnificent Seven companies, by Microsoft, Nvidia selling the chips, by Facebook, which apparently someone told Merryn was actually the mystery 13% customer of Nvidia. You know, single company was 13% of Nvidia's.
I like the way you're pushing that little bit of uncertain data off onto me.
Anyhow, but in the past, it hasn't been the case that at the inception of a technology mania, your engines that move markets,
yeah.
that the favoured stocks in the boom have not actually been the ones to benefit. And I think, you know, when Ross, you were talking about the .com. Yes, it's true. Amazon, of all the internet stocks that were being touted in 1999-2000, eventually emerged as a winner after falling more than 90%. But Google came to the market later. Microsoft and Cisco came to the market in '86 in a very quiet time. So, in fact, actually, the technology winners tend to come to the market outside of periods of market euphoria. And the assumption that the AI revolution, that all those profits are going to accrue to the Magnificent Seven, is just, I think, an assumption based largely on their fine and outstanding performance up to this date. What can change is trust busting, is the public, and that can be, you already at the FTC, I can't remember her name, the woman who's in charge of...
yeah, I can't remember. But,
something
her whole thesis, she wrote a thesis on busting up Amazon.
Yeah.
Yes, and so the heat is being turned up. You could imagine under a Republican, a Trump administration, having had his clashes on Silicon Valley, he could turn up the heat more. So we may be, we were talking, you have this cycle of regulation, 2011, no Justice Department antitrust prosecutions, and we may be at a cyclical change in which these monopolies that have been given a free ride actually come under greater pressure. I mean, I can think of half a dozen ways in which you could make the likes of Facebook or Google more accountable for the stuff that appears on them that would massively destroy their profitability. So it's really only a question of will.
So one way to do this would be to look at the market capitalization and then say, what's it discounting in terms of future earnings? You can make, there's a band there, but you can have, and then say, what percentage is that of GDP? Okay. And then ask yourself, in the history of that economy, have we ever seen these companies have that higher percentage of GDP? And I think that would have been useful in the dot-com bubble as well. So I actually haven't done that calculation, but given the size of the market capitalization, I think it's assuming that they will get to a percentage of GDP which is dangerous to liberty. And I think I mentioned yesterday that obviously the flip side of this, and why it goes on forever, is corporatism. You know, if a president or if a leader gets into bed with these companies and we create a corporate state, because they're so powerful, a political leader gets hold of them, well, they're going to make a lot of money for a very, very long period of time.
And Nick Clegg would be president of the world.
Yes. He keeps coming up, but I'm sure Nick Clegg has got designs on this. You know, as I said yesterday, a man who never saw an act of democracy that he was actually in favour of. So somebody, you know, that's how it doesn't burst, I think. Because obviously what we're saying here is politically, it's just not sustainable. Okay. But with a president who wanted to use them, it could be sustainable. I'm not sure that's a world we want to live in. It's not a world I want to live in anyway, but that's how I think how it gets sustained.
Okay.
I mean, the one rebuttal being that when Standard Oil was broken up, I believe that was the best time.
True.
Yeah.
Absolutely true. That's absolutely correct.
Yeah.
Just on the final
yes, places
Russia.
where Nick Clegg hasn't taken over yet.
Okay, so
Russia, China, Turkey, Poland.
Right, well, let me do, so China I think is going to zero. Not in the way things usually go to zero. So is anybody in this audience who has shares in Sberbank? So
I probably do. No, I don't think I do.
So Sberbank was, and is a very, very cheap bank. I mean, it's a real value stock on a grand scale. But actually, because it's a Russian bank, it really doesn't have value. If you sell Sberbank, you get ruble. Getting ruble into dollars, I'm told by some people it can be done, but you know, I think.
No, but all the Russian investments are marked down to zero and are just sort of cordoned off in these funds. So whether you like it or not,
so it's gone to zero.
It is a zero, and you can't legally invest in Russia.
I don't think you can legally invest. I mean, it depends where you live, I think.
But you can claim
live in
capital gains
Moscow.
losses.
So Russia is a vassal state of China.
Yes.
Okay, so you don't want to invest in either of them. When they're the Chinese, if the first Chinese tank appears in Ukraine, it's going to be the same thing. So I think China and Russia are all investable. Poland is different and may well be investable. And I'm not allowed to go to Turkey anymore because of previous misdemeanors. So basically saying it was going to go bust, you know, in 2012, and it did basically go bust. So I've got an open mind on Turkey, actually. You know, the problem is the rule of law. Do you have a rule of law, or is it run by a strong man who can change the rule of law? Well, that is the risk, isn't it? But at these valuations, perhaps finally. I think when I started writing about Turkey, the exchange rate was 2 to the dollar. Now it's 30 something to the dollar.
So just on Russell's point on the rule of law, I think this is a mistake that investors in foreign markets make. Is they look at cheapness and opportunities, and they don't consider whether there is the rule of law. And in countries without the rule of law, your investment's not secure, and therefore, and what follows from that is that conventional valuation isn't a reliable indicator of potential returns. So that's particularly the case for China, and obviously was the case for Russia. So I think the rule of law, in terms of investment mistakes, not paying attention to whether you're investing in a country of rule of law and that your capital is inherently secure, is one of the prime mistakes people make.
So we always say 10 times buy everything, but there are exceptions. So the breakdown in the rule of law, which would include communism, destruction of your capital stock by enemy bombing. You know, there are extreme outliers to this where you do not buy at 10 times earnings.
Okay. The French had two-thirds.
The French
had 2/3 of their international investment in Russia in 1917, marked to zero. So that probably is the greatest investment error of a nation, of that tear gas spraying nation, but of all nations in history. There's probably never been a greater loss.
Brilliantly brought to a closure with the idea of mistake. An hour slipped away, as it tends to with three brilliant talkers. We can continue this conversation outside, and on a day like this, I would recommend, if you're thinking of what to do with the next 15 minutes before the final session, go up to the viewing platform and clear your mind and report back here in 15 minutes' time. Okay. Thank you.